And the stock game today, including the rate of return. We talked about the rate of return exercises that we're going to be covering. This is going to be something today, we're going to do this stuff together so that you can see how this stuff actually works. When we're measuring our rate of return, we honestly want to find out if we're making money or losing money and at what rate. So to also go in with this, guys, I'm asking you for this week, by Wednesday, for each of your groups to write down your 3 to 4 stock picks and to send them to them. Let's cover this a little bit in detail. If you lose all of the money, the $100,000 you've been allocated, can you still get an A on this project? Absolutely. So think about why you're picking the stocks you're picking and send me 3 to 4 stocks that you're picking. We're going to be doing the rate of return exercise. That'll be due on the 23rd. When you get back, it's something you can literally do in about 5 minutes. Now, guys, Mentorship Day, just a reminder, the 25th is Mentorship Day, and I'm requiring everybody in this room to go to a session to make up for this class. Otherwise, you get a writing assignment to do. I'd rather you go to the mentorship session. By show of hands, how many of you are already signed up for a Mentorship Day session? If you are not, get signed up for one. You're going to be writing a paper. I would really rather have you go to Mentorship Day. Guys, these are our groups for the stock game. I have some interesting titles. We've got Team County Money, the Hustling Houdinis, the Associates, Grizzly Stocks, the International Team Spicy Pickles, Profiteers and Moneymakers. Nick, we got to get you in a group. You're the one guy who did not sign up for a group. One of the 2 groups that only has 3 people you can join. So you're either on Team Grizzly Stocks or Team Moneymakers. He wasn't on the email.
I sent it.
I didn't see it, man. I'm sorry if I missed it. So you're in with these guys?
Yeah.
Okay. Done and done.
No, I'm not spicy pickles.
You're in Spicy Pickles?
Yeah.
I did not see it in the email. Sorry, guys. So if you're in Spicy Pickles, great. That sounds like a wonderful sentence to say. Who wouldn't want to be in Spicy Pickles? Okay. So your group isn't listed up there. That's what you're saying. Grizzly Stocks. That's correct, isn't it? Yeah. I was going to say, I thought I had you guys up there. Okay. So Nick is in Spicy Pickles. Everything is wonderful. The world is good. Guys, you're asking how to monitor your portfolio, and I'm here today to show you how to do that. You have a couple of options you can use for monitoring your stocks. You can use your smartphone if you like. You can use Google if you like. I happen to use Yahoo Finance. You ask, why do I use Yahoo instead of Google? Honestly, because I have an account. I've been using it for years, so it's something I'm very comfortable with. I'm going to give you a brief demonstration of how this works in terms of Yahoo Finance. Right now, I have an account with Yahoo, and I have a list of portfolios that I follow. You're welcome, by the way, if you've got your laptop, to follow along with me if you want to set up a Yahoo account. Who here has a company they're interested in? Will somebody tell me a publicly traded company they're interested in following? Yes. Great. So if we wanted to search for Apple, here we go. So we can see Apple's stock price. We can see right now that as of the close on Friday, it was trading for around $236. Now, if you look here, we can even buy and sell. If you put this and tied it to your bank account or your brokerage account, you actually can do this right through Yahoo Finance. I'm not suggesting you do that. I'm saying that you could. If you want to, for example, I already have Apple on my watch list, but you can add it to a watch list. So, for example, in this class, I have several watch lists that I follow, and I have several industries that I follow. I do follow the cannabis industry because I think it's interesting to see what's going to happen with that. But let's go back to my portfolio, and we'll go to my watch list. So right now, these are 48 stocks that I follow. And for example, I already have Apple on there, which is why it did not give me the option to add it to my list. But any one of these stocks that I follow, I can instantly go on to. Let's say, for example, I want to see what BlackBerry is doing. Believe it or not, BlackBerry's actually had kind of a market resurgence this year, even though their hardware share is down. Okay, well, I can see right now that the previous close on Friday, it closed at $5.06 a share. Its open was $5.14 a share today. If we go to chart settings, I can go through and interactively from the last date range from years to months to even 5 years out and go down to a particular date and see what that stock was trading for. I can zoom in on that stuff as well. If you want to use these kinds of charts to show me in a particular range, for example, what your stock was doing, you certainly could. If we want to make the date range a little tighter, for example, let's go 1 month. It'll break that stock down so we can see by specific dates where our stock was trading. So since today is the 14th, we're going back to the 16th, which is the last trading day within 30 days in September. And we can see very quickly what the information was, what it opened at, what it closed at, how many volumes of shares it did. If we want to go and get historical data, we can click on historical data and set a custom date range. It'll give us a chart very similar to the ones that you have seen right in your sample paper that I gave you, and you can set a custom date for that. For example, if I wanted to see 1 year, I can do that. I can also say, let's say 6 months. So if we're in October now, actually let's go back to, let's say, June of this year. And we'll make it 6/14/2019. I can get a custom range of dates and be able to see just that era if I want to see what it's done in the short term. So very easy ways to do that. Again, if you go back to BlackBerry, if you go back to the summary, it'll tell you anything you want to know about the stock. It can tell you, for example, what they think in a year you're going to be making per share. And look at this, right down beneath here, there are news articles about your stock. So for the articles that you need to provide in terms of your references, if you're using Yahoo Finance, right here they are. You can find them. Does anybody, by the way, know how to do a screen capture on their laptop so you can turn whatever's on your screen into a graphic? I'm going to show you something that's going to change your life. If you hit Shift Print Screen, just do this for me once. Hit Shift Print Screen on your laptop. Hit Shift Print Screen on your laptop. Hold them down together. And I want you to open up a PowerPoint file. So hit Shift Print Screen on your laptop. And now open up PowerPoint. When you get a blank slide on PowerPoint, I want you to click Paste on that slide. So go ahead and open up a blank slide and hit Paste. So what I'm showing you how to do, guys, is how to capture these graphics. Is anybody able to copy and paste? Did it work for you guys? Here's my point. All these charts that you guys see in the document, I just showed you how not to have to create the manual. Everybody able to do that? All right, cool. Guys, in terms of anything else on this, because I use Yahoo, I think I'm very familiar with it. I like it. It's very easy, for example, to get in and get historical data, charts, any of these things. Anything that adds graphical value to the period in which you're covering your stocks. You've got one day, or 1 month rather, you're covering from the 1st to the 31st of October. I would make all your date settings go along with that. Why would you want to look at historical data on your stocks, by the way? Why would looking back a year make sense? What do you think, guys? Why would you want to have some history behind your stocks? Yes? Is this a hot stock or not? What's it typically been earning? The flip side is, because none of us are experts in the market, it comes down to, wow, this stock could be poised for a rally, could be poised to come back. If it's been low, and you're saying, hey, it's really low, so I've got lots of money, I'm going to buy lots of shares of it, you've got a high tolerance for what? You got it. If you're a risk taker and you make big money because you think one of these stocks is going to come back, great. If you look at somebody who consistently earns, you're looking at your Amazons and your Apples, for example, that means you may want to take a more low-risk approach to your portfolio. So again, if you get in here, you can create your own follow list. You can create your own profiles. And for example, I'll go back to my watch list, just some of the shares that I have been watching myself. Very quickly, even by looking at the stocks you're following, if you look at the day event, you can see the last day of trading, how your stock was doing if you want to take a closer look at that for the day. It's very easy to add something to this. You search for a symbol. Will somebody give me another company? Somebody they're interested in following? What companies are you interested in? Uber, good one. So if we go to Uber, and we can see, for example, how they're doing for today. Uber Technologies has been pretty level. If you look here, for example, the last, let's go back and look at 6 months with these guys. They started off pretty strong when they went public earlier this year, peaking out, right around $45 a share. And then we look at yesterday, or I should say on Friday, they traded off at $28.95 a share. Pretty interesting. Their volume's pretty good. We got 10 million shares in circulation. But look at their 52-week range. From the time they've come out, they peaked. If we look up here, they peaked right around $47 according to the last 52 weeks, and they bottomed out right at $28. That's a pretty good spread when you think about percentages. So if you want to follow Uber, that's how you do it. I recommend Yahoo Finance. You are welcome to use the aggregator of your choice. What questions do you have? You have to sign up for an account to do this, by the way. It's free, but you have to sign up with an email address and give them some of your personal information. Any questions, guys? If you're planning on using something on your smartphone, that's fine too. I think that's great. The only thing I would say that there's an advantage to using something like Google or Yahoo Finance, for example, is the screen capture is a little easier. Sure, you can capture screen captures on your phone as well. You could also create an account and let everybody in your group have access to it if you all wanted to use the same account. That's one particular strategy. Okay? Any questions, guys? Going once. Going twice. Sold. All right, guys. Today we are going to cover a rate of return exercise. What I'm going to ask you to do, close your laptops and pull out a piece of paper, because we're going to do this math together. I want to show you how this works, so there's no question you get into rate of return, so you know how this works. Now, guys, what we're doing here is not going to be graded. I'm doing this for your benefit. We have two stocks that we are thinking about investing in. We've got Ford and we've got Harley-Davidson. Now, everything that I'm going to be showing you is made up. These are not actual stock prices. This is made up for the principle of doing the exercise. So right now, we've got $100,000 to invest. And we're saying to ourselves, we like Harley, we like motorcycles. So we're going to put $60,000 in Harley. We've allocated 60% of our portfolio to go to Harley-Davidson. Ford, we've allocated 40%. 40% of $100,000 is $40,000. Can we buy partial stocks? We cannot. Remember that. So we're going to get into the math here, guys. Right now, we are trading at the beginning of the month. This happens to be the month of March we're doing trading, and we're buying Harley. So do this math with me, guys. We're going to say we have 50 shares of Harley that we're going to buy, and we're trading at we're trading for $50 a share. If we take $60,000, take $60,000 on your phone or on your paper and divide it. If we're trading for $50 a share and we have $60,000, how many shares can we buy? Is my math correct? Is it correct? Okay. Now we have Ford, who is trading for $9.50 a share. If we want to find out how many shares we can do of Ford, we're going to divide $40,000 by $9.50. Is my math correct? What do you get when you divide $40,000 by $9.50? I'm not literally do this, guys. Divide it on your phone or on your tablet. And tell me what you got. You divide 40,000 by 950. What do you get? It's not going to be an even number. It's not going to be a complete share, I should say. What do we get? 4,210. Exactly. And we can't buy a partial share of stock. So we can only buy 4,210 shares. So what we have right now, we have spent an even $60,000 on a Harley. We can only spend $39,995 on Ford because we cannot buy a partial share of stock. So when we divide 40,000 by $9.50, we get 4,210 shares. To determine how much you actually spent, do this with me, guys. Take 4,210 times 9.5. What do you get? This is important to remember because right now you had $100,000 to invest. How much did you actually invest? You had two types of stock you bought. So add those two together. How much did you actually invest? Say that really loud.
99,995.
Exactly. So that's how much we actually invested. If we had $100,000, we could have invested, but we only invested $9,995 because we could not buy a partial share of stock. Yes, I'm repeating that because 4 out of 10 groups, every time I do this exercise, do their final math wrong and divide their total by 100,000, even though they didn't invest 100,000. So here we're going to see our rate of return. We decided on the 21st of March to sell. So we had Harley Davidson. We bought it for $50 a share. We sold it for $53 a share. So we made $3 a share. Good for us. How do we determine how much money we actually made? We take the 3 times the number of shares we originally bought. So somebody multiply 3 times 1,200. I know the answer's up there, but I want you to walk through this. Yeah, so we made profit. To determine how much profit, to determine your rate of return, you divide what you actually made, which is $3,600, by the amount you actually spent, and you get a 0.6 rate of return. Now, when you're doing this actual math, take it out to 4 decimals. A 6% rate of return is pretty darn good, especially for all the longer we had that stock. We made some money on that stock. Not so good with Ford, for example. Now, Ford, we bought at $9.25 a share. Or, I'm sorry, we sold at $9.25 a share, and we bought at $9.50. So we had a negative return of 25 cents per share. Now, again, because we did not invest the whole $100,000, will somebody take 0.25, negative 0.25 times 4,210? Check my math for me. What do we got? Am I correct? Okay. So to get our rate of return, keep in mind, this is a negative number. We're taking negative 1,052.50, and we're not dividing it by 40,000 because we did not invest 40,000. We invested 39,995. Will somebody do that math for me? 1,052.50 divided by 39,995. What do we got? So my math is correct. So we have a 2.6% loss. Again, I know it's repetitive. You've got to divide by the money you actually spent. So we know, for example, what our individual rate of return is. What we want to do now is determine what's our whole portfolio rate of return. We take the amount of money we made at Ford, which is $3,600, and we subtract the $1,052.50 that we lost. I'm sorry, 36 was from Harley, the loss was from Ford. We end up with a total profit of $2,547.50. Great. We got to divide that by the amount of money we spent now, or the money we put into the market. So we put in a total of $60,000 plus $39,995. So how much did we actually invest again? $99,995. So to get our rate of return, we're dividing our profit by our actual investment, and we get what we refer to as our rate of return for our whole portfolio, in this case, 2.55%. Guys, does that make sense? Okay, the places where people lose a letter grade on this entire project is by not realizing you cannot buy partial shares of stock. The place where people lose a whole letter grade on this assignment is not by not adding everything properly and instead dividing by what they thought they had to invest as opposed to what they actually did invest. This is how you're going to do your assignment that's due on the 23rd. What questions do you have? Any questions? Going once. Yes, ma'am.
What are the dates you want for getting the stocks and
The stocks, the entire game runs the entire month of October. So it's the 1st of October to the 31st. Other questions? Keep in mind, guys, this is a substantial part of your final grade. If you don't have the grade you want right now, this has boosted people's grades. So pay attention to this stuff. You can make a really good final project. You can really boost your final grade or maintain it. Other questions? All right, guys, we're going to continue then. We left off talking about the differences between stocks and bonds. And before we get into today, because this is all about making sure you're retaining this stuff, can somebody tell me between those two investments, which is a higher risk investment, stock or a bond? Stock is a higher risk investment. For this side of the room, why is a bond a safer investment?
Like, you keep
Exactly right. When you take on a bond, you're taking on debt. You owe somebody money. But the flip side is they can't control your company in the same way this side of the room. If you have stocks, how can somebody who is not part of your company control your company? They own stock in your company. Yes. Exactly right. You get one vote for each share of common stock. Do you get voting rights with preferred stock this side of the room? You get preferred stock, John. Do you get a vote or not?
Sorry, say that again.
If you get preferred stock, do you get a vote or not? You do not get a vote with preferred stock. So that's the difference. What do you get, other side of the room, if you have preferred stock? What do you get first in exchange for your voting rights? You get dividends first. Exactly correct. So guys, when we start talking about stockbrokers, we're talking where we can actually buy shares of stock. Now these can be online. These literally can still be people answering the phone. These can still be folks right out of the Wolf of Wall Street, although they're an endangered species these days. Brokers make money by selling you shares of stock on commission. So in other words, if they are selling you a share of stock, they are getting commission every time they sell a share to you, just like a traditional kind of car salesman or any other kind of salesperson. The online brokerage firms have changed the market, though, guys. You can even sign up for some of these accounts and get a commission-free trade or a number of commission-free trades. So when we call a stockbroker or we click buy, this is a negotiation process, guys. When you make an offer for a share of stock, it's not a done deal. The person who's holding your stock can decide whether or not they want to sell it to you and at what price. So you can negotiate on the price of stock. You can put a range in which you're willing to pay. You can put a ceiling or a floor. When the stock gets down to this price, I will buy it. If it gets above this price, I'm not interested. And a stockbroker does those investments on your behalf, whether they're a robot or whether they are a human being. By the way, guys, how many of you are thinking of being finance majors or are already finance majors? What's the biggest threat to that industry in terms of employees in the next 10 years? Automation, artificial intelligence. Trading is a very complex process, but it's also data-driven, and computers are getting way better at processing this data than human beings. So when we're buying securities, now guys, a security can be a stock or a bond. So when we're buying securities, we got to think about these certain things. By show of hands, who here considers himself to be a risk taker? By show of hands, who here is conservative in spending their money? Who here falls somewhere in the middle? All right. If you have not yet raised your hand to prove to me you're listening to me. All right. Some of you are not listening to me. That's okay, because we're going to try to liven it up to get you interested because we're talking about money. Guys, investment risk is the first thing you should be thinking about. How quickly am I going to see my money out of this? How quickly am I going to see a yield? Duration, liquidity, and tax consequences. We're covering these one at a time. Anytime you buy something that does not have a built-in inherent value that is permanent, you're taking a risk. Generally speaking, guys, there is one thing that most people agree is a pretty risk-free investment. And it's got some element of risk. What seems to be the most risk-free investment you can possibly make? Generally speaking. You got it. It always comes back around at some point. That's not universal, but it tends to be pretty low risk. You're hoping that whatever you're buying is worth more sometime more than it is today because you want to get your money back out. Now your yield is how quickly can you get your money back out of the markets? For example, if you're playing the stock market, you're looking at sometimes a quick turnaround. How are bonds different, guys? What's different between stocks and bonds when it comes to yield? Yes? Yeah, exactly right. But that's got to be paid back at some point in time. So if you want to know when that debt is getting repaid, think about things like bonds because they have a shelf life. If you're taking out a 60-month bond, it's going to be paid back. Now, your yield is what you usually expect in the coming year. How many payments am I getting this year? That's my yield. Now, how long you've committed is your duration. Guys, generally speaking, if you're going in long term, if you get a slower rate of growth, that's okay. You're looking at it as something that's going to pay off over the lifetime of the investment. That being said, if you want to get your money in and out very quickly, you've got to typically go for higher risk investments. So the higher the risk, the greater the reward, generally speaking. Now, liquidity means if you had your money into a company or an investment or security, how quickly could you get it back out? Let's say, for example, we had a company that was on shaky footing. Somebody who's not doing well. The company went bankrupt. They closed. How do you get your money back out of that company if you're an investor? Any ideas? Sadie, if a company goes bankrupt, how do the investors get their money back? What are things that companies own that have value? Yeah, absolutely. Intellectual property. That stuff gets sold off. Help Sadie out this side of the room. What's something else that companies have that has value if they go under? Yes. Totally. Assets, physical assets, intellectual property assets, actual stuff you can sell. So look, if a company is liquid, if you can sell off that stuff very quickly, you've got high levels of liquidity. In terms of tax consequences, guys, we all know that bond interest is deductible. Great, that's wonderful. Is revenue from shares of stock, is that tax exempt or do you pay tax on it? Do you get dividends, do you pay tax on it? Absolutely correct. So you got to think about those kind of tax consequences too. What are you getting out of this? If you make a profit, you're going to be taxed on your income that you make on stocks, for example. Now, some people, when they get into investing, for example, want to make an impact. They may say, I'm not going to invest in companies I don't believe in. I am going to invest in companies that do ethical things. For example, some people in this room may not want to invest in R.J. Reynolds. Why is that? Why would you or would you not choose to invest in R.J. Reynolds? Close. Anybody know what R.J. Reynolds makes? Cigarettes. Who here wants to invest in a cigarette company? If you don't believe in the product, don't invest in it. The other part of it is, guys, you can also choose to invest in companies that are doing good things. For example, there are companies that will do micro-lending or low-interest loans to developing countries, for example. You can invest in those and make money back. We call that impact investing. And even some of these folks like the New York State is doing high-impact bonds for social causes that you can invest in and get a really good rate of return on. So you can make investments into things that you actually care about as well. Don't even look at the slide, guys. I want to know your input here. And I know you're all tired, guys. I know we have 5 days until mid-semester break. But let's get some energy in this room. Seriously, guys. I'm seeing a lot of tired faces. What could we do today to get you in for another 20 minutes? What would get you going today? I'm up for suggestions. I see people checking their schedules. I see people going to sleep today. People checking out. Guys, we got this time together. What can I do to make it worth your while today? Because we have to be here. Help me out. Seriously, guys, let's make the most of this. I will open it up for a conversation, a question, even if it has nothing to do with what we're talking about in class here today. I really want to get you guys in. So, bless you. First of all, guys, bless you. We go for 3. All right. Guys, who here can tell me why they are interested in the markets in the first place? Is anybody interested in the markets? Why should you care about this stuff? Yes. Absolutely right. Why should you guys individually care about the markets? Yes. Well, that's one. That's for sure. Why else? Why should you care about the markets? I'll ask you. Why should you care about the markets?
Because that determines I don't know.
You guys are beat today. Seriously, what can we do to get you guys awake? Yes.
I was gonna say like it's how it's doing can affect like what economy we're gonna be getting into.
That's exactly right. Well, and specifically, how do the markets affect your life when you get out of college? You ever want to retire, guys? I do. I wanted to retire sometime. Guys, this stuff is all what goes into basically is going to give you a lifelong income. The reason you should care about this stuff is because things like Social Security are not going to be there in any great way for people in this classroom. I strongly believe that. This stuff is going to end up being what makes the difference between whether or not you retire at 60 or 70. By show of hands, and I'm not, look at me once, guys. Everybody, look at me. Guys in the back, look up this way once. How many of you guys have ever seen somebody over the age of 65 working a counter at a fast food restaurant? Raise your hand if you've seen that. Do you want that to be you? That's why this stuff is important. So that's why we're spending this time talking about this stuff. Guys, the ways that you can get into this stuff, if you are playing the markets, if you've heard of Robinhood, it's an app you can download for your phone. Play the markets now. Go join the investment club here at St. Francis or Annapolis. Do something like that. Spend some time reading this stuff. Think about what this means to you and why. Hell, talk to your parents. Ask them why their retirements matter to them. I'm sure you're going to get a lot of different answers, guys. And in terms of where you're going to get your large rates of return, believe it or not, guys, you get higher rates of return with smaller companies. Shocking. Now, when we look at this, we got higher rates of return. Larger companies give you lower rates of return, but where are you probably still going to make more money? Exactly. Because a smaller rate of return on a larger amount still matters more. So that's what we're talking about, guys. Now, corporate bonds, you can still make good money. Now, when the bond market starts going up, when bonds, secure investments start looking more attractive to investors, for example, when people start seeing higher rates of return, or I should say, when there's more movement in the bond market, that could be a negative impact for the economy or indicating we've got negative things that are going on. So that's an example why you would diversify. Guys, when I say that we want to have a diverse account, what do I mean? Yes?
I don't want to put everything into one area.
Exactly right. Why would you put all your eggs in one basket? Why does that axiom exist? We put all our investments in the same place. Why is that a bad idea? Yes?
Like if you put all your stocks in one industry, for instance, it's possible that a single industry can tank.
Exactly right. I mean, think about this, guys. If everything you're investing in is all part of one or related industries, and that industry goes south, you got problems, man. You got no backup plan. You diversify. I like the idea of putting in multiple types of investments. Why not put things into high and low risk? Now, you guys being younger than me, much younger than me, you probably have a better chance of tolerating risk than I do, not just for your personal tendencies, but then why else would you be better at tolerating risk than me? Age is part of it. Because if I completely screw up, what's going to happen? I have less potential time on the planet than you guys do. I'm going to be in the cold, cold ground as worm food. You guys are going to be seeing your profits go crazy. And you're going to be saying, man, that old Tonka guy had a bad day that one day in October. But man, he was making some sense. I'm sorry he's dead now. You may say that. Or you may not. It could happen either way. But it comes down to have a diverse portfolio. In fact, I want that to be written on my tombstone. It's going to be in quotations. Kent P. Tonkin, 1973 to 2019, and in quotes it's going to read, he encouraged us to diversify our portfolios. You guys will be bringing roses to my grave and say thank you for our great rate of return. It's going to be amazing. It's going to be good stuff. I'm getting morbid this morning. But it's probably because I went to see that new Joker film this weekend. Who has seen that movie? Guys, did that movie not stick with you? How about the scene in the apartment? I don't think I can watch it again. Anybody who has not seen that movie, approach with caution. Would you guys agree? Yeah, that was an intense film. So that being said, since we're going into all these dark spaces today, so guys, other things, the reason that we get into investment, the number one reason that people who are not corporations invest is what? Actually, I'd say the number 1 and 2 reasons. Why do people invest? Mackenzie, what are the number 1 and 2 reasons that people put money into the markets? What do they hope to get out? Yeah, we're talking retirements. And what's the other thing that people always invest in? Not their house, but something that's connected to them in a whole different way. What else do people put money in the markets? Has something to do very directly with all you guys. You may even be sitting in seats in this room. Yes? Yeah, exactly right. People want to make sure they pay for their children to be able to have an education. Other things, for example, in terms of financial advice you can get are tax planning, estate planning, etc. So, guys, in terms of the markets themselves, we're going to get to that in a second. I feel like for the next 15 minutes we have together or so, I want to get something moving around this room. So when I walk around the room, when I stop by you, I want you to tell me something you're thinking about today, something that's on your mind today. It could be good or bad. It could be about anything. I may stop anywhere in the room today, so anybody is up for grabs today. Graham, what's something that's on your mind today? What was the toughest scene for you? That was terrifying. Terrifying. Who here has not seen the movie yet once? All right, I'll no spoilers. But did you figure out the refrigerator machine that? I don't know what that meant. Crazy. Yeah, nuts. All right, who else? Who else is up to discussion today? Shelby, what's the first thing on your mind today? I'd give you some of that too. I'd love some sleep. Just not in here, not in this classroom. I'm going to stay awake. Who else is up for grabs today? Oh, I don't know. Miss Minerva. Yes.
Excited about lunch.
What do you have for lunch?
That is what it has to offer.
So what are you hoping for? Is there something that like, man, this would make my day? Oh, yeah. Is this the chicken patty sandwiches? Those used to be the best thing over. Chicken patty sandwiches were the best. You have to get maybe one more person who's got something on their mind today. What I should do is like actually do some kind of lottery or something where we draw numbers and see who's got something to say today. Who's got something to say? What's on your mind? Thanksgiving. It was Canadian Thanksgiving. I just found out about that, by the way. I feel bad that I didn't know that was a thing. To our Canadian friends, happy belated Canadian Thanksgiving. We inherited a lot of good ideas from Canada, and that's one of them. So, guys, we're getting back in. We've got two perceptions in the market. We've got bulls and bears. The bulls and the bears. Isn't that funny? They're both Chicago sports teams as well. Bulls are people who think the markets are going to do well, so they charge. Bears are people who basically think it's time to hunker down for the long cold winter. Guys, how does one of those market strategies or the other affect the way that you invest? How would a bull invest differently than a bear? Yes?
Bull would take more risks than a bear.
Yeah, because the bulls are thinking what?
That they're going to get a higher return.
Exactly right. Spend it all, man. We're going to make some money, and the markets are going to come back. What drives a bear's investment strategy? What do you think? How does a bear approach the market? Yes?
Kind of like a longevity approach.
Yeah.
Stocks have a better volume.
Hunker down for the winter. What do bears do this time of year in Pennsylvania? They hibernate. They basically spend the... Imagine if that was your life. You have this period where you're saying, I'm going to eat as much as I possibly can to get as fat as I possibly can so I can sleep for 4 months. That's... there's some wisdom in that approach. You really have a good life for a pretty good part of the year. You're either eating or sleeping. It all works out pretty well for the bear, I think. Getting shot and made into a rug, that doesn't work out for anybody. But yeah, I do not understand. Who are my hunters in the room, by the way? Do any of you hunt bear? I do not understand the draw of dragging a 500-pound animal out of the woods. Nothing about that sounds fun. I do not get it. But anyway, capital gains are, once you make money on a stock, you have experienced a capital gain. If you make money on a stock, what do you got to pay? If you make money, what do you got to pay? Taxes. That's exactly right. So we're going to talk about the different investing strategies you can make. We have poker players in here. Who plays poker? No poker players. Well, people like blue chips in poker. If there are stocks that have perpetually made money, we're talking about, for example, your Lockheed Martins and your Procter & Gamble. By the way, Does anybody know what Procter & Gamble makes? They make everything. Great answer, by the way. They're like one of the biggest companies you've never heard of. They make everything. Lockheed Martin, who here knows what that company's involved in? Yes. You got it. Big money, man. Big money in defense. These companies hardly ever lose money. They are good investments, generally speaking. Growth stocks are stocks that could be high risk, for example. And we think that they're going to be growing at a higher rate, not necessarily meaning you're going to make a lot of money. Because a high return on investment, a high rate of return on a low-cost stock still maybe isn't that great. But if you're getting into technology, biotech, things like pharmaceuticals, that's where we see some earnings there. Income stocks, we're talking about utilities. By show of hands here, how many people have internet at their house? Okay, by show of hands, how many people have electricity at their house? By show of hands, this is the last one, I promise, how many of you have city water at your house? Okay, here's the trick, guys. Internet was stretching a point. But city water and electricity, generally speaking, most people don't have a lot of choice. You have one choice in which you can buy your city water from, and that's generally the city. You might be in a deregulated area for electricity, but it's still coming over the same power lines. So utilities, generally speaking, are safe investments because they're perpetual. And so, for example, even when the economy goes to hell, people still need to heat their homes and they still need running water. Penny stocks, if you've seen The Wolf of Wall Street, this is what we're talking about. We're talking about stocks that are less than $5, generally speaking. We call them penny stocks because you can get into the market for pennies. It works out really well. So, guys, if you are high risk tolerant and you've got some money to spend, you might want to get into the penny stock market. So, guys, here's a question for you. Let's say, for example, this side of the room and this side of the room. You guys own 40% share in a company. You guys own 60% share in a company. And we just decided we're going to have a stock split. Our board of directors has decided we're going to split stocks. 40% and 60%, now we're going to split the stocks. Has control of the company changed? Who says no? Who says yes? Who has no idea? Guys, it's okay not to know. The percentages remain the same. So if you own 2 shares of stock and tomorrow you own 4, the person who had 4 shares of stock who now owns 8, the proportions stay the same. So you may ask yourself, why do companies split stock? So I'm going to ask you guys that. Why would a company choose to split their stock? Yes? Exactly right. So could there be a time where that would be advantageous to a company? Exactly right. Exactly right. Will somebody look up for me the price of Amazon right now? What's their share price?
$1,724.45.
Could that be prohibitive to some investors? That's big. That's a high stock price. Compare that even to companies like Uber and other tech firms, for example. If you're Amazon and you're still getting good volume at that price, God love you. Keep it where it is. But you might, for example, want to split that price, or split that stock to be able to make it more attractive to new investors. I have a brief video for you on why companies. So guys, we're going to end it right there for today. I am going to encourage you by tomorrow, actually by Wednesday, if you would. By Wednesday, if you would email me 3 to 4 stock picks that you have. Carbon all members of your group on this email, so everybody is in the same loop on this. Start looking at an aggregator. If there's a particular aggregator that you would like to see or would like to use that for this project, or if you need some help with Yahoo, hit me up. Our next assignment is going to be due on the 23rd. It is a rate of return assignment, so I would take some review over the slides we covered today. Wake up, guys, and have a good day.